Okay, greetings. This is Sean Taylor. We're here to do an analysis of the Louisiana top publicly traded companies. This is Finance 695, summer 2013. The overview and scope of the project is to analyze the equity securities of the sample group, of which 22 companies were chosen, and to identify the most attractive options to include 3 to 5 of those securities in a portfolio, and then limit those down to one top or strong financial pick, and that financial pick will be analyzed further and recommended for investors to put in their portfolio. In addition, is to gain a deeper understanding of the practical application and the tools presented in Finance 695. Theory of the analysis. Basically, we have analysis parameters, which are the characteristics of a successful company. And basically what we want to do is utilize the timeless indicators and of companies that are or might be good investments. These characteristics include earnings, return on equity, and their relative value compared to other companies. In addition, other performance data will be used to determine and to help pick a security to invest in, along with the aforementioned key characteristics above. Specifics of the analysis will include the liquidity ratios, profitability ratios, the DuPont analysis, as well as key stats, PD ratio, P cash flow, and price to book ratio as well. Valuation, beta, and current news. Upon initial evaluation, there were several companies that we identified that really didn't meet our criteria. Really want to put out there a disclaimer that we're not saying that these companies are not financially strong or that they're not worth investing in. It's mainly they didn't meet the criteria that was set forth for identifying a financially strong company. A couple of those companies that we identified early on were a Global Star. Global Star, although a relatively good company, had a few red flags that were raised initially once we performed the analysis. The ROE was negative, ROA was negative, as well as the profit margin was negative. And these sent up red flags initially, as well as the operating margin and the weighted average cost of capital, all were negative. So with these red flags, we kind of decided to back away from Global Star. They had a beta of 2.78, which it's a risk preference, and it was a little more risky than I would have endeavored to pursue. In addition, Medicis, negative ROE, ROA, and interest burden, along with the weighted average cost of capital. And it also had a beta above 2, which, as we all know, beta above 2 is twice as risky as the market, and for the return, it was not worth it. Also, Energy Partners Limited, EPL. The available liquidity was really low, and that kind of bothered me from saying, hey, yes, this is something we want to invest in. So I opted not to pursue these options, those three primarily, during the initial analysis. Okay, um, there were companies which did kind of stand out as financially strong companies, companies that really said to me, "Hey, let's take a deeper look, let's take a deeper dive, and kind of investigate these companies and see which one would be the best." And really, of the ones that we chose, five strong ones. Really, I would be interested in putting all five into a portfolio, and investing in all five. All five are relatively strong companies. They had some very nice positives and some comforting points as well. Um, 3M definitely stood out amongst the group as one of the leading and forefront from a financially stable and strong company. Um, Pool Corporation stood out also. Mosaic Fertilizer stood out. Very strong um, liquidity, as well as CF Industries. Um, Another one that kind of stood out that shocked me and I actually like it was Albemarle Corporation. Um, I think it's a undervalued stock right now, and I think it will definitely have the potential to grow and bring great value to the investor in the upcoming future. Okay, now because we had five different companies that, as I mentioned, we were very interested in, and I would have liked to put all five in a portfolio. Um, the particular company um, that we selected and included in the investment portfolio analysis as the strongest financial company out there was 3M. And just to give a little background on 3M, from the industry and sector, it's a conglomerate, and it's operating above the sector average PE of 14.9, but below the sector average ROE of 28.6. The international company, formerly known as Minnesota Mining and Manufacturing Company, operates in everything from adhesives to personal hygiene to paper products for office supplies, and it's well rounded from a diversity standpoint. 3M, it was founded in 1902, and it's headquartered in St. Paul, Minnesota. This is going to be one of the primary reasons why we're going to look at other companies that have a vested interest in Louisiana. Later we'll discuss. From an analysis standpoint, 3M involved in multiple markets that allow it to absorb any of the major fluctuations in the market. Um, these fluctuations, pose some concern, but it 3M is diversified enough to where it can absorb those. It has a low beta below 1, 0.965. This is below the market, which means it puts me at a very comfortable risk level, so that I'm not concerned when the market fluctuates. So I'm okay with that. It's stable. It has a consistently high ROE, 25.96 currently. It dropped over the last few years due to the reduction in leverage. Is what I noticed once digging into it a little deeper. They reduced their leverage, which, as you know, leverage magnifies gains and losses. Um, Increase in PE ratio as a result of increase in stock price, what we determined. The current PE of 17.8, so that's definitely a good sign. Means the market likes them. I think they definitely have additional potential to grow. The liquidity ratios are very attractive. Current ratio of 2.33, quick ratio 1.48, and the cash ratio of 0.74. These values, the current values from the Bloomberg terminal, and they add a sense of comfort when you think about their ability to cover any current liabilities over the next 12 months. So they have a very attractive, appealing outlook to the potential investor. As mentioned earlier, they're well diversified. This also poses a risk um, to, uh, to the giant. It becomes a target for international competitors trying to steal a market share. So we have to be aware of that and acknowledge that there is a risk there that other large conglomerates or even specialty companies may try and steal a market share from one of their 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 their, their product avenues. Uh, with that said, I will not analyze 3M because, as I mentioned earlier, they do not have a presence in Louisiana. They're based out of St. Um, St. Paul, Minnesota. So, with that said, I'd like to look at another company that I believe, as I mentioned earlier, has potential to grow and to bring some surprising dividends. And that's Albemarle. Background of Albemarle Corp. Develops and manufactures engineered specialty chemicals from a variety of markets. They market polymers, catalysts, as well as purity metal, high purity metal organic products. And these products, are just amongst a host of others that Albemarle designs, manufactures, and markets. The company was founded in 1993 and is headquartered in Baton Rouge, Louisiana, which is one reason why I chose it as a company that I say would be interesting and well worth investing in, along with its financial analysis. The industry and sector, specialty chemicals, basic materials. It's operating on the leading edge of the sector. PE average of 15.9 is the sector average. Their current PE is 19.57. Last year they ended in 14, the upper 14 range. They're below the sector ROE average right now, and it's 21.5, and they're currently at an ROE of 14.7. With a 2014 ROE projection of 23.6. So this is kind of from the calculations why I decided that this would be a company that has some potential growth. We can probably get in on a potentially undervalued stock and get higher returns over the next couple of years. Looking at an analytical summary of Albemarle, the liquidity ratios were very attractive, as were with 3M. The current ratio, we know current ratio is current assets over current liability, is 3.23. So that in itself was very interesting and attractive in itself. They do seem to have a decent amount of cash on hand, which can be of some concern. Quick ratio, current assets minus inventory over current liability, and that's 1.94. Cash ratio is cash plus cash equivalents divided by current liabilities, which equal 1. So we don't have a problem or concern with them being able to meet their liabilities, at least in the short run. The profitability. I think the profitability speaks for itself. They have a PE of 19.57. The market likes the company. Maybe a bit overpriced right now, but I believe that'll continue to drop. They have dropped some, and I believe we get in low. And over the next couple of years, I believe we'll regain ground and be able to recoup some of those earnings. Price cash flow, 11.78 at the end of the fiscal year 12, and price to book 3.011 in the fiscal year 12. also. The return on equity. Return on equity was 14.7, and that's the current with fiscal year 14 projections of 23.61. So again, these projections, after doing the numbers, I think definitely gives a future opportunity for growth and shareholder wealth. Beta's 1.6, which it's 60% more volatile than the market, riskier than the market. But I think overall, in summary, Albemarle is a company that you can get in, invest now or in the near future, and over the next couple of years will definitely provide some interesting returns. Thanks.